Hello, everyone. Today on the final bar, I'm joined by Marc Chaikin of Chaikin Analytics, going to share with us his take on the overall environment, give us one name that is top of mind for him. Overall, we have the S&P continuing to push onward and ever upward, despite negative breadth conditions, despite plenty of stocks that have already retraced, some of the downside or moved to the downside, and especially in the cyclicals and others, getting a nice bounce today on stocks like Disney and others as the S&P moves higher. Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon and welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets through the lenses of technical analysis and behavioral finance. Focus on visualizing market dynamics and really modeling investor behavior by looking at trends, measuring momentum, and leaning into what's working and leaning away from what's not working. As I've mentioned many times before, I think your goal as an investor should be threefold. Number one, identify trends. Number two, follow those trends. Number three, anticipate when those trends are exhausted. And if your goal is to identify trends and follow those trends, and if you're looking at the S&P 500, it is hard to debate that the trend has been anything but overwhelmingly positive. You have a market that continues to make higher highs and higher lows. We keep remaining above an upward sloping 50-day moving average. However, there are plenty of stocks that have rolled over. And we're going to look at some of the evidence from some of the names reporting earnings this week. Also, a bit of a deep dive into sentiment indicators, some of which have bounced a little bit, particularly the name exposure index. We'll get to that in a minute. I'm excited to talk with Marc Chaikin. He's someone whose work I guarantee at some point in your day you were leaning into if you were a technical analyst or if you use charts, because he's designed many of the indicators that we use regularly. Coming up next week, we have three great guests for you. We have Gary Dean from sentimenttiming.com on Tuesday the 10th. On Wednesday the 11th, Samantha Leduc from Leduc Trading. On Thursday, August 12th, we have Matt Tuttle, portfolio manager and founder of Tuttle Capital Management. He created the first actively managed SPAC ETF, which we'll be able to talk about. And then coming up the week after, on Tuesday, August 17th, we have Sean McLaughlin, options expert from All Star Charts. Let's continue on with today's market recap. You can see the acceleration to the upside on the S&P 500 on the two-day preview chart here on our dashboard page. Really the last 30, 40 minutes pushing on to the upside. And looking at a chart of the S&P 500, we see we're once again at all-time highs where we've been really for the last couple of weeks. We've sort of been in this range revolving around the 4,400 level. And again, it's this uptrend I don't think should be surprising by now in terms of the resilience of this uptrend, continuing to make higher highs and higher lows. The concern that I have in this market is the concerns we've talked about, I feel like for many moons, which are things like bearish momentum divergences, which we're currently once again in the midst of. Things like breadth that is coming off, right? So you have stocks the market making higher highs, while plenty of stocks are not participating in these uptrends. Notably, areas like small cap, sort of traditional offense, where you might expect doing very, very well in this sort of environment, struggling quite a bit. Let's look at some of the particulars to today's trading. The S&P closing just below 4430. That's up 0.6%. From Wednesday's close. The NASDAQ 100, about the same. The NASDAQ composite actually performing a little better, up 0.8%. Mid caps and small caps had a pretty decent day, and they've been lagging a lot of the time recently, but the S&P 600 was up 1.4% today, and the VIX is back around 1725 or so. In terms of interest rates, you had yields back going higher. So the last couple of days, we've seen interest rates chopping higher and higher with the 10-year yield just above 120, 121, almost 122 here. And the dollar index literally flat. The dollar index really hasn't gone anywhere. And you've had that, that run higher in the dollar. And from there, since it reached sort of that 25 range on the UUP, sort of been sort of a choppy sideways sort of move for the dollar index. Commodities as a whole did just fine today, and the energy sector was number 2 from the top of the list on stronger oil prices. Precious metals down with the GLD down 0.4%, just below 169 on the close. That's after yesterday really selling off, sort of gapped higher and gave most of that back out of the open. Cryptocurrencies in general up today, with Bitcoin really accelerating to the upside through the course of today's sort of equity trading day, back above 41,000 here as we're recording, and Ethereum up about 3% from yesterday as well. We looked at a chart of the S&P 500 already, so let's focus on some of the sector themes here. So we have financials, number 1, energy, number 2, and then a fairly defensive sector, utilities, number 3 from the top. These are the 3 sectors up over 1% today. And, the strength in financials is interesting, right? We've seen this, this bounce in some of the cyclical sectors. I think one of the concerns of the market, or one of the challenges, are all these cyclical sectors that have rotated lower, while some of the growth sectors like technology and others have held up just fine. Today, you see rates coming back up. You see the yield curve sort of back to steepening a bit, and you see financials holding up very well here. Looking at the financial sector, we've talked about it at times. It's actually been in a range bound scenario, right? Financials were the leadership. They were the juice really into May, into early June here. If you look at the XLF from there, look at how the relative strength really rolled down. And from mid-June to mid-July, it's been a question of, or not a question, it's been, the reality has been weaker banks, weaker financials versus the rest of the market. The XLF, though, is a beautiful illustration of what's called polarity, and that's where a level of resistance becomes support, or it could be the opposite, where support becomes resistance. Look at how the XLF hit resistance in March, again in April, finally broke above that in mid-April. Now, when it comes back down off of the all-time highs, you find support once again a number of times on that same level. So what we've talked about when you have a level of support like that is, as long as we remain above 35, the chart is not broken. It may have been underperforming, which it did, but that's a pretty fair, bounce off of support a number of times. Above 35, this is still a very constructive chart. And now all of a sudden we're rotating back above the 50-day moving average today and threatening to get above these swing highs from June and July. I could see that as being a pretty constructive development for the financial sector. You get the XLF breaking back above those swing highs from June and July. So that's the big move down off the all-time highs. But then in this range, and this potentially is resolving that range up to the upside. I think tomorrow and seeing how we close the week will be pretty telling. What sort of weekly close do we lock in? What can that tell you about a potential rotation back into the financial sector? Now, within the financial sector, there have been plenty of pockets of strong performance. The specialty finance names we've talked about a number of times, things like Moody's and MSCI and SPGI are in that group that have been pretty strong and consistently strong, even in the face of the financial sector struggling. But now you're actually getting some of the larger cap names within there. Some of the banks and others that are rotating higher a little bit. We actually highlighted Morgan Stanley on the new swing highs list earlier this week, if I remember right. Now you have a lot of companies reporting earnings, and let's spend a little bit of time just highlighting some of those. So Square is coming out as we're recording this. So as usual, we don't have much time to dig into the earnings releases as we're recording the show, but just to talk about some of the setups leading into it, Square is a really interesting one. We talked about PayPal before, which has bounced up against resistance, and the question is, can it break above the previous swing highs from a number of tests earlier this year? You're sort of in a similar bucket for Square. If you look at the high in February, the high in April, we're kind of right back there. It certainly appears to be rotating back to more of a period of accumulation. That's what the last couple of months have been demonstrating. We're sort of right at that point. I'd be very keen to see if Square is able to make it above those previous highs. We call it around 280 or so, which is right about where we close. So I'll be very interested to see about the release today and what that means for it. But overall, setting up fairly well. Virgin Galactic is another one here. When we're looking at this one, it's really midpoint. I mean, this is a huge range from the 60 down to 15. So it's kind of an unfair range to be talking about. But I think what the key here is we're right about at the 200-day moving average. And we saw on the chart of Disney, we talked yesterday about the chart of Disney and how it was potentially bouncing off of the 200-day moving average. You're actually seeing it, rotate back to the upside today. A nice sort of bounce higher with it. After hours, Virgin Galactic actually trading up about just under 5% to 33, which will put it right about here or so. So it's bouncing a little bit off of that support level, back off of the 200-day moving average, assuming that continues into trading tomorrow. So certainly an interesting chart to be looking at. Before the opening, I had a couple names in the healthcare space. We've been talking about the strength in the healthcare sector and its rotation from underperforming to outperforming. Regeneron before the open today, closing up about 3.7%, getting back above $600 a share. I think the story with Regeneron from a technical perspective is a real rotation. If you take a step back and look at this chart, you can see the rotation from distribution phase to accumulation phase, right? A period of lower highs and lower lows to a period of higher highs and higher lows. And I would argue that the higher lows that you've seen in March, April, May are really start to tell the story of this rotation. Getting back above the key moving average is absolutely important. And just look at the 50-day moving average, how it spent so much time below the 50-day, then finally broke above it, tested it a couple times and keeps going higher. That's really the sign of an improving technical situation. The high from January, I think, was a really important one. That's sort of where we bounced off of. We didn't quite make it down to there, but I think that 560 level is a really important one to watch. And as long as we remain above that during this consolidation phase, things are remaining pretty constructive. At this point, you see it starting to resolve to the upside. So stronger earnings could potentially be that catalyst Regeneron needs to reapproach those previous highs around 660. We need to take a quick commercial break. We'll be back with my guest, Marc Chaikin. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close for our show. A couple quick announcements before we get to my guest, Marc Chaikin. Number one, we'll do another mailbag segment on Friday's show. We would love to hear from you. Any questions that come up as you're analyzing your own charts, as you're using stock charts to try to make sense of the market in uncertain times, we're here to help point you in the right direction. Shoot us an email, thefinalbar@stockcharts.com. You can look us up on Twitter at FinalBarSCTV. We're on YouTube. Just put a comment below the video that you're watching on our YouTube channel called Stock Charts. We would love to hear from you, gather those questions, and hope to answer your question on the air on tomorrow's mailbag segment. Also, please go to StockChartsTV.com. Use your email address. You can set up a free account there. Start watching all of our fantastic content immediately. All of our great shows like The Pitch, and specials like Charting the Second Half. Wonderful guests like Marc Chaikin and many others, all featured on demand from that website, StockChartsTV.com. Also, from your mobile device, just look on the App Store for StockCharts TV on demand. I want to welcome on today's guest, someone who I think needs very little introduction. If you've used charts or technical analysis for a period of time, you certainly have been impacted by this gentleman's work. Marc Chaikin is the founder of Chaikin Analytics. Has created some of the great indicators that many of us use, things like accumulation distribution, Chaikin money flow, and also a new plugin which you're featuring on our ACP platform. Marc Chaikin, welcome to the show.
Dave, good to be with you.
So we talked in our market recap a little earlier about the S&P 500. There's no doubt we're once again sort of teasing another all-time high today as we're recording the show. Talk us through your perspective. What's the big picture look like for you?
It's similar to yours in that I've keyed in on the higher highs and higher lows, which to me is the simplest way to define an uptrend. And what I'd like to point out on this chart is how we've bounced off that 50-day average with Chaikin money flow very, very strong. And to me, that says that smart money is buying the dips. But in this case, smart money is now the Reddit crowd. Mm-hmm. Retail investors came in big time when we had that spill down close to 4,200 in the S&P, 420 on the SPY. Mm-hmm. And that's been a pattern since the lows in March. And so the retail investor is now creating big demand for the 6 largest cap stocks in the S&P. It's become a self-fulfilling prophecy. They go in and they're now buying ETFs. They're buying the QQQ and the SPY. And that creates instant demand and instant bid for the FANG stocks. And I think that's going to continue. And Chaikin Money Flow tells me that's likely to happen. The big caveat is, look how we've had roughly every 4 to 5 weeks a pullback. And we're now in a period from seasonality point of view when we would expect the market to run into resistance, the sort of dog days of August heading into September. So what I'm saying here is the market is moving higher. The big banks are raising their earnings estimates. Goldman Sachs raised their price target on the S&P to 4,700 today. And I think that's possible, but not before a pullback. So I think we're in a market of stocks. Right now, the large cap stocks are benefiting from a lot of very positive earnings reports and this buying by retail investors in the ETFs, SPY and QQQ, where they know they're going to get big participation. But I'd like to emphasize that it really is a market of stocks. So moving on to the stock that I've picked to talk about, and it does relate to earnings, we're looking at Fiverr. Very positive fundamentals during the lockdown, people selling their services online for anything from $5 to $500 and up. But the Power Gauge rating, which you talked about, the new plugin on ACP, which synthesizes the fundamental factors underlying a stock's price performance, is very bearish. What happened today? Better than expected earnings, but terrible guidance. And look where the stock is, down almost 25% today. That's why I say this is a market of stocks. We had that earlier in the week in Clorox. You've got to be really careful, especially here during earnings season, to avoid stocks with a very bearish rating, because these stocks are the most vulnerable to something you really can't deal with, which is a gap opening lower, which I know from sad experience, very difficult for retail investors to deal with.
Yeah, it's such a great example, and I love how you're combining the plugin's beautifully done, Mark, and I love how it combines what you and I have talked about a number of times, is sort of that fusion of fundamental and technical analysis. I think if you're just looking at the charts, in a lot of ways you're missing the story behind the chart and these companies' ability to grow earnings over time. But at the same time, if you're looking at the fundamentals and missing the chart, you're missing some key information about the supply and demand picture, right?
I've always believed that investing success is contingent on both fundamentals and technicals. The problem is fundamental analysis, as you know, Dave, is time consuming. It's hard. Mm-hmm. And that's why we created the Chaikin Power Gauge rating, and the ability to see it on the ACP platform with your favorite chart configuration. In this case, I do what I do every day, which is relative strength and Chaikin Money Flow. Mm-hmm. And Scooter is wonderful for that relative strength picture. Chaikin Money Flow tells me what the accumulation distribution is, and the fundamentals sort of fall into place when you click on the chart symbol in the list. So I'm thrilled that we're up and running on ACP. It's something I've wanted to do for a long time. And I think that anybody who's been using Chaikin Money Flow, it is one of the technical factors in the model, but it's not significant. Fundamentals really drive the model. Anybody who's been using Chaikin Money Flow will benefit from knowing what the underlying fundamental picture is.
It's well said, Mark. Now, we only have about 30 seconds left, but I'd just love to ask you quickly, if your sort of general thesis, the macro perspective that you mentioned, does play out and you get sort of that seasonal weakness that I think many would probably agree with, where would you be looking opportunistically? We've had a lot of the cyclicals that, as you mentioned, have certainly been beaten down, but starting to improve. But on the other hand, we have charts like Microsoft and others, Facebook, that seem to be impervious to anything and continue to go higher. Where would you be looking opportunistically in the coming weeks, given some short-term weakness?
I'm looking at software, semiconductors, technology in general. The big cap stocks, I think, are going to continue to lead this market higher. So stocks like NVIDIA, Oracle, Advanced Micro stocks, which was down somewhat today, stocks that are going to benefit from index buying. Microsoft also looks strong, Facebook, as you point out, and Alphabet. Alphabet's been my favorite FANG stock. I think these stocks are going to continue to move higher. And now that you can buy micro shares through the big online brokerage, the retail investor can participate even in a stock that's trading at $3,000.
Absolutely right. Mark, listen, thank you so much for giving us some time. I know you have a lot going on, but appreciate all that you've done. Thanks again for sharing your take on the world. Stay safe, be well. We'll talk to you again soon.
My pleasure, Dave.
That's Marc Chaikin. Marc's the founder of Chaikin Analytics. And again, it's a pleasure to talk to someone like Marc about how to combine some of these different inputs, because these are things that I was taught as I just joined the industry and have worked with many investors over the years doing that. And guys like Marc are the ones that have really paved the way and helped us come up with better ways to visualize accumulation distribution through things like the Chaikin money flow. As he mentioned, we just released a new ACP plugin with a partnership with Chaikin Analytics, featuring their Power Gauge stock rating system. It appears as a panel on the side of ACP. So if you're interested in that, bring up StockCharts ACP on the right. You'll see the little plug, and you can see the new plugin from Chaikin Analytics. Let's continue on with our next segment, getting sentimental. So a lot of the weekly sentiment data is updated on Wednesday into Thursday. It's a great time to check in on some of the sentiment readings. And as we've talked about on the show before, when I think about the big picture and how to make sense of things, for me, it's a three-pronged approach. And it starts with price and then goes to breadth and goes to sentiment. And in priority order, that's sort of where I would look at things. If you have nothing else, as you heard Marc Chaikin mention earlier, right? The thing he keyed in on are the higher highs and the higher lows. We have all these tools in our arsenal. At the end of the day, is the trend positive or negative? And I think that is the very first question you should be trying to answer. So I think that's point well taken. The second piece of that is breadth. And I think that's where you get to understand the dynamics underneath the hood. What are the companies that make up the stocks that make up those indexes? What are they doing? And then sentiment is a third piece, which is where you get more into anecdotal evidence. And you think about the relationship between, the price of the market, the price of assets and what that tells you about supply and demand, and also sentiment, which is more survey data and looking at other markets and trying to quantify what people are thinking. And I think it's a great way to qualify what you're hearing. JC Peretz, who hosts a show, All-Star Charts here on StockCharts TV, I was on his podcast just yesterday morning, if I remember right. We recorded that and had a great discussion. We went in a little more depth about sentiment and contrary opinion. So look that up if you missed it, if you want more details on some of the key sentiment indicators and what they mean. Having said that, let's start with the VIX. We'll look at volatility. Now, I would say one of the things that JC and I talked about this week was, when we call the VIX the fear gauge, I think we're shortchanging its value just a little bit. In general, does volatility spike when the market's going down? Yes, right. And if you look, there's a general inverse relationship between the movement in the S&P 500 and the movement in the VIX, and that makes sense because when people panic, they don't just kind of panic or kind of sell things. They panic sell, and you make rash decisions, and as a result, the volatility can spike. However, there are plenty of times when the market is actually going higher and volatility can increase. And we've actually seen that sometimes, year to date, we're actually seeing an increase in volatility. And it's not necessarily a bad thing. It's just more descriptive about the conditions underlying the environment or underlying the market and what's going on. I think what's interesting about the VIX for me, taking a step back, is just this overall transition from what was a very elevated VIX range from about 20 to about 40 through the second half of last year. And that was after the huge spike in the first quarter, obviously with the market sell-off. But then from there, you sort of settled in. We bounced off of the 20 level very often. Now, we've spent very little time in 2021 back above the 20 level, especially after the first couple months of the year. From there on, we've actually been in a relatively lower range. However, that entire range is still way above what we were a couple years ago in 2019. It's actually a really low VIX level. So what's happening now is when the VIX is spiking above that 20 range, that's indicating that we're sort of in that pullback phase, and we may be nearing some sort of short-term bottom, based on the trends that we've seen so far in the last 6 months or so. So I would certainly be interested to see if we get an increase in volatility, what that might mean in relationship to the movement in the S&P 500. At this point, the VIX is currently around 1750, which, to be honest with you, is a very middle of the road reading for what we've seen over the last 4 months. It's really where we've revolved around since March into April. So not an extreme reading on either way. We're not seeing extreme low volatility, which is more classic with market tops. The VIX has been much lower than it has, particularly at the end of June, early July, when the VIX was touched around 15. So not really getting a warning sign from volatility, I would argue, based on historical trends. The bullish and bearish sentiment using the AAII survey, really not significant either, right? Extreme bullishness would be the AAII bullish reading above 50. That's what you saw back in April. Now, when I talk about the stealth correction that I think we're in, that's what I think that this chart illustrates, right? The bullish peak, the peak in bullishness so far in 2021 was at the beginning of April, end of March. It's not now. Now you're actually at 36% bulls versus 56% bulls back here in April. It might not have been quite that high, but pretty high in the mid to high 50s. So the peak, according to peak bullishness, was back here in April. This is when a lot of stocks started to roll over, despite the fact that the index is going higher. A lot of names have already pulled back a great deal, and I think that's what this change in bullishness has recognized. So we're not getting this extreme bullishness that is classic for bull market tops. That's just not the scenario that we're in at this point. One interesting rotation high over the last couple of weeks is the name exposure index. We've talked about this a number of times. The name exposure index surveys money managers and basically what's your allocation to equities, 100 or 200% long, 100 or 200% short, or 0% equities. It spiked up over the last couple of weeks. It was down around 70% 2 weeks ago. It's almost back to 100%. We were right about this level about 6 weeks ago. Sort of in mid-June, which was the last time it was up in this range. Above 100% is sort of my basic back of the envelope extreme bullishness reading. That's sort of the euphoric range. Very interesting to see going into next week if we do get above 100%, especially if we get a little further uptrend and the S&P continues to make new highs. That's when I think you start to be concerned about the anecdotal last buyer has already made their action. They've already taken their new positions, and who's left to push the price higher. We haven't been in that elevated reading for the name exposure index. We may be getting back to that level. We need to wrap the show here. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1, we talk about deteriorating breadth conditions. I've mentioned many times what I call the stealth correction. Even though the S&P is going higher, plenty of stocks have been in a pullback phase. And the question is, how does this resolve, right? So the big mega cap growth names start to come back down to earth. The things roll over. Stocks like Apple unable to hold their breakout levels and come down, and the index is correct as what you might normally expect in August into September. Some of the breadth indicators sort of confirm that configuration. The peak and the percent of stocks above their 50-day moving average was back here in mid-April. From there, it's essentially gone lower. It came up to around 60%, back down this week to around 54% of S&P names above their 50%, which what that means is almost 40% of the S&P were above their 50-day back here in April and now are below their 50-day moving average. So you've seen the correction play out on a lot of individual charts and groups and sectors. The question is, does this rotate back higher? Do you see stocks reclaiming their 50-day? That would certainly be a bullish sign that would signal an all clear of sorts rotating higher. Chart number 2 is biotech using the IBB, one of the more liquid biotech ETFs. Certainly seen an improvement in the healthcare sector, the relative strength in the XLV improving, as we've highlighted recently. Biotech is one group to certainly pay attention to. The IBB making a new swing high this week, eclipsing its February peak. You can see how the relative strength is making a new 3 to 4 month relative high. The group is improving, and overall the trend in pretty good shape. Overbought, which doesn't concern me a ton. You could see a brief pullback, as you often do when a group becomes overbought, but I think that's more indicating this renewed strength in a space that had been underwhelming in the second quarter, really starting to improve and get its legs underneath it on the move higher. Walmart, chart number 3, as a public service announcement, there are always charts making new 3-month highs and new 3-month lows. Today's example is Walmart, WMT, in an unloved sector, consumer staples, but there are opportunities even there. The relative strength not super exciting, but the price able to break above new swing highs, which is impressive. Folks, that's our show for today. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Marc Chaikin from Chaikin Analytics sharing his thoughts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.